And here we are, boys. Welcome, welcome, welcome. The highly anticipated bootcamp is finally here. I've already made like 8 or 9 of the episodes, but this is the only one that I have not pre-recorded since it's the intro. Episode 1, nothing too crazy today. We're getting you guys started off the right foot. Got a lot of exciting news for you today. If you are new with me, welcome. You are in the right place. You will literally find no model like this. Everything I do here is going to be completely for free. I'm teaching everything I've built and have been trading exclusively for the past year and a half, completely for free. The main reason why I'm doing this bootcamp is because I've never done something like this before. Every video I made in the past has always been some type of like confluence video or a trade recap, and it's required a lot of effort on your half to go in and kind of watch my videos and try and piece it together yourself. And I've seen a lot of people just like genuinely just like making shit up, like they're just inventing rules out of their ass, to be honest with you. I just realized my fucking fly's up or down. Whoops. They're just inventing fucking rules. And so I need to come here and teach you every single thing in case they fucking take me out. I'm teaching you the Macre mechanical model. This is something that I invented and have been trading exclusively since last July, so over a year and a half at this point. I did switch models, not switched models. I use it in conjunction with another model you guys might have heard me talk about. That's called Squid. I do not teach that. I don't have anything for it. It's just a private thing. Lock behind NDAs. I want to make that very clear. It's a top and bottom taking strategy. That is not what I'm teaching. Here I'm teaching the mechanical model, which I've used basically my entire trading career, and I still use it every single day. It is what I'm basically most famous for, most popular for, and that's what I'm teaching you. It's highly, highly profitable. I don't know how much money it's made, to be honest. I'm close to about 200K in profit, and then if you look at my Discord, dude, it's probably close to $1 million. I don't even fucking know. The amount of people that haven't reported profits, I have no idea how much my model has made people. I have no idea. I've live streamed my trades for free since last November, so over a year of, or no, shit, even longer than that. Almost 2 years of live trading, more like a year and a half of live trading. I don't know how much money the model has made. I paid my way through college, I paid my way out of college, and now I'm here, okay? And I've basically only used the mechanical model up until recently, as of like October, when I originally moved from the mechanical model over to my top and bottom ticking model, and now I use both of them at the same time. Because ultimately, every model is trying to accomplish the same thing, just different ways of getting in that movement. So this is my shit. All the stuff here is nothing you can find anywhere else. I'm gonna have to teach some of the basic concepts to you guys the way that I know them and the way that I learned how to do them. I always get asked, like, how do you start trading? How do you do it? And it's just like there is no good answer, right? Because I don't have a boot camp, I have confluence videos, but if you haven't learned the basics, then you're fucked. So don't worry about it. You don't need anything else. You can start here and you can end here. That's what I want to make easy for you guys. I feel like for so long it's been kind of put on you to go out there and figure it out yourself, which, to be honest, is the way you should have done it, okay? I've been doing this shit. There's a lot of you that haven't watched my shit. If you're new, put a little one of these in the fucking comment section. Say, I'm a pussy bitch. I'm a pussy bitch. I'm starting on the boot camp, even though my videos have been live for a year teaching about this shit. Whatever, okay? I'm a pussy bitch. I needed it to be organized. Whatever, okay? It's fine. You're here. I'm glad you're here. You're locking into the right concepts. That's what's most important. Like I said, or I guess I haven't said, but I'm not here to upsell you on anything. I'm not here to sell mentorship. I'm not here to sell a course. Literally teaching you something that I've invented, created, mastered, and taught, as well as made hundreds of thousands of dollars on. I've changed my entire life. I dropped out of school because of this mechanical model before I even had Squid, okay? Understand me when I say this. This shit changed my fucking life, and it will change your life if you allow it to. But again, it's completely your decision. That being said, I want to share a little announcement I have with it. Obviously, I have an indicator. If you want to get the indicator, I'll talk about what that's used for as we get through the boot camp. We're going to talk about the mechanical model, what it's accomplishing today. That's our main goal, to focus on efficiency, understanding market efficiency today. But you can get my indicator. It's going to be completely necessary if you want to make money with the model. Not in the beginning when you're learning, but if you want to make money with the model and use it long term, my indicator is in the comments as well as in the bio. You can use Code Troop and save some money. If you do get the indicator, we have a separate Discord channel. See if I can share it on screen. I got some tech out too. Let me get the tech open real quick. Oh, please tell me this works. Oh, come on. Oh, please. Oh, this is so we're at loss. I'm not editing these videos, by the way. If you guys don't know, I don't edit shit. Not because I'm lazy. It's because, well, I'm lazy. Kinda. Why does it look like that? Ew. Okay, so that looks fucking horrible in every way. Whatever, this will work. So if you take a look here, okay, you see we have an indicator section. This is called the Real Troopers Only chat. We are the troop. Welcome. This is the Real Trooper only chat. Basically, what this is used for is for me to communicate with you guys directly. If you have the indicator, in fact, I was about to announce it. If you have the indicator, you'll get access to the Real Trooper only chat, which is just exclusively the people that are most locked in with the model. It's not the global chat. Global chat's fucking retarded, bro. There's 10,000 something people in here, and they are all paint huffers, bro. I swear to God. So I built 2 new things. Not getting paid for this, by the way. Like, this is just because I want to, and I know that's going to make more people profitable. We have a trade journal section where I outline how you can set up trade journals, and I will be reviewing these every single day at 11:59. I'm going to go through all the trades that you guys submit on the day and see how you did, make little comments, react, all that kind of shit. And that way you can get feedback from myself as well as the community. And then also we have an Ask Macre section where you can specifically ask me questions about, whatever you want to ask me. They're just testing it out right now. This is the easiest way to get the right questions answered the right way, not from some fucking paint huffer who just wants to bullshit with you. This is a direct pipeline to me. So if you want to access that, again, indicator, buy the indicator, give me your money. I live off an indicator, trading doesn't work. That being said, let me change this shit back because holy fuck. Come on. Join the Discord too. It's completely for free. Live stream's completely for free. I live stream my trades for free. I'd say every day, but to be honest with you, it's not every day, bro. I've been slacking. But that being said, let's get into the Macre mechanical model. I've said everything I needed to say. Welcome to the Bootcamp. I am going to turn you profitable. That's my goal. I'm going to turn you profitable. It is not going to be easy. It's going to be a little bit hard, but you don't have to do the hard part. I invented all this shit. Okay, I don't want to hear it. Oh, trading's hard. Oh, my psychology. Oh, motherfucker, I had to invent the confluences. I had to create this shit. All you have to do is click buttons. Beep, boop, beep, beep, boop, beep, 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 boop. That's all you have to fucking do. That's literally it. I had to invent this shit. I had to build out these rules. As far as I know, at least how I've communicated with my financiers, I've probably spent about 20 racks for all the rules, not just for Mech, but also Squid. I probably spent about 20 racks for both of them, so I don't want to hear it. That being said, what do you need to start off with? Very, very simple. You need a TradingView subscription. At minimum, you need the essential plan. It's like fucking $10 or some shit. It's dirt cheap. Get a fucking job. You need the essential plan. That way you can backtest. You need that shit. You fucking need the essential plan. You also need live CME futures data if you're going to chart on TradingView, which you need to chart on TradingView. TradingView is where we're going to be doing all of our charting on. Okay? You need to get the CME data. It's $7 for NQ, ES, MNQ, MES, gold, silver, all of the CME futures contracts. You need CME live data. It's $7 fucking dollars. On top of that, if you want to get the indicator, it's $35 or some shit. That's it. Okay. On top of that, if you want top step accounts, if you want funded accounts, which we're going to be going into later, you're going to have to cough up some money for that. Trading genuinely has a pretty low intake for how much money you have to spend up front. It's not that bad compared to other business models. So if you can't spend like $200 a month on trading, you're fucking cooked. You need to get a job. And if you're one of those fucking slims that live out there in like fucking Pakistan or some shit, and you make like 7 cents every week, man, you got to start money glitching, bro. You got to start fucking jugging, bro. You got to start snatching chains or something, because I'm sorry, brother, but it's just not going to work out for you. So today's goal is to talk about market efficiency, the beginning of the Mech model, explaining a little bit of the Mech model. I want to get the conceptual shit out of the way first. I think that people learn best when we talk about the theory behind why things work before how things work, because this shit can be confusing for a lot of you guys. I guess I do probably, like I said, there's no fucking itinerary for this shit, boys. I'm just going to click record and then click end record until I feel like I've said enough to turn you guys profitable, and I'm not going to stop till I finish. So I don't really know how I didn't plan any of this shit, so I probably should teach you how to read candles, I guess. I guess that's my job. But before that, I want to talk about theory. I want to talk about concepts. I want to talk about what a profitable model is trying to accomplish, what an unprofitable model isn't, what an unprofitable model is also doing, and essentially why Mech is the best way to take positions. So that being said, very simple shit. If you're new to fucking candles, first of all, and you don't know how to read this shit, it's so fucking easy. You got bullish candles, yep, you got bearish candles. Bullish candles are price going up, bearish candles are price going down. Okay? It's very simple shit. I'm going to delete my indicator for a second just to briefly explain this, right? Here's a bullish candle, right? See this bullish candle? Price opens here, price closes here. Here's a bearish candle. Price opens here, price closes here. These wicks are unconfirmed tests of price, meaning price did not close within those ranges. It moved within the allotted time that candle was trading, but it was not it didn't close within this range. So we can look at this to analyze wick behavior. We can look at this to talk about pointers, to talk about all my concepts. But ultimately, all that this is unconfirmed, unclosed price within the time allotted on this candle. A time frame dictates the price activity between one time and another time. That's all that a time frame is. So a 5-minute time frame is 5-minute open to closure, right? So this is essentially 5 minutes of price action happening here, 5 minutes of price action happening here. You go to 15-minute time frame, 15 minutes of price action here, 15 minutes of price action there. It's very simple shit to read. Now, the equities that we trade futures. Futures are essentially contracts that bet on the future price of an asset. This is used to stabilize the economy way before, so people can have a way of not predicting prices, but having a way to bet on prices, predicting in the future with what they have now. It started off with like fucking potatoes or some shit. I don't even fucking know. That's what a futures contract is trying to accomplish, okay? The main futures contracts that we trade are going to be MNQ and MES, being NQ and ES, being NASDAQ and S&P 500. The two most liquid funds that exist in the Chicago Mercantile Exchange, or CME, or that's just like our two biggest indexes that we're going to be trading. They're highly liquid, very hard to manipulate. They're going to move very cleanly, okay? There's also gold, there's also silver, there's also oil. The reason why I choose to trade NQ and ES is because they're correlated, and we can use that correlation, or sometimes lack of correlation, to make money. Why are they correlated? Well, think about it, right? They're indexes, meaning they are, if you don't know what that is, a basket of assets, right? So an index is, hey, I'm a company, I'm a piece of fucking paperwork, and we're gonna invest in X amount percentages in all these companies. Okay, that's what an index is, a collection of assets and investments in something. It's a portfolio that's being managed. The reason why they trade similarly is because those two indexes are relatively equal in terms of what they contain. There's some differences, right? NASDAQ is typically going to have, I think we can even open up the holdings. If we go here, I think we can open up the holdings. NASDAQ's typically going to lean towards your tech sector. Where's the fucking holdings at? There's a way to look at it. Oh, wait, I think it's this. We got to go to the stock equity. I forgot. We'll go to QQQ. It's the stock representation of this on the New York Stock Exchange. Go to QQQ. We'll go to holdings. Should be right here. And these are all the investments that the NASDAQ has by percentage, right, in weight. And you'll notice that most of these are tech sector stocks. You probably can recognize most, if not all, of these equities. And you'll notice, again, if I were to compare this to the S&P, you'll see that these equities are relatively similar in what they control. Go to holdings. Right, you got Nvidia, you got Apple, you got Microsoft, you got Amazon, Alphabet. Very similar shit with some exceptions. The S&P is supposed to represent the broader stock market, but the U.S. stock market is relatively forward-looking on tech, no matter what. So NASDAQ's just going to be a little bit heavier in tech. So yeah, that's why they're correlated. They share similar assets. That's the only reason why. And so because of that, we can take advantage of that in price action and small disassociations and associations to take trades. Those are the two equities that we're going to trade when we're taking positions. Now, the thing is about NQ and ES is that they're different prices, right? And so you can't use the same amount of contracts when you're trading them, right? You can't. Like one NQ does not equate to one ES. They also have different tick values, meaning they move at different quantities when you're in a position. We're going to be talking about position sizing and how we're able to take specific amounts we're going to take in different contexts when we're taking trades. The way I trade and teach Mech is that I take all my positions on MNQ, even if there's a setup on ES, because of correlation and because of what we're going to call correlated pointers. And it doesn't really matter because we're betting on both equities moving in one particular direction. I take it on one equity so that I can standardize my risk on an account. Because if you can get your brain used to a certain amount of drawdown over time, then you're not going to freak out as much if you were to switch equities and change your size. Like if you trade the same equity at the same size every day, that drawdown is going to get slowly more comfortable for you. Sometimes if you switch to yes and you up your leverage or whatever because you're trying to scale up, that risk change might mess with your psychology. So I standardize my risk and just trade one equity. That's literally my entire process with Mech. Does that mean you can't trade ES? No, 100% go trade ES. But the way that I teach Mech and the way that I explain Mech is if you're betting on NQ, you're betting on ES. If you're betting on ES, you're betting on NQ. Those are the two equities that we trade. We trade funded futures. I will be moving to a live account. My general goal is once I hit an M, once I'm worth an M, I'm going to move to a live account. Just my own personal rules. I want to have like a $250,000 live account, but right now I'm just not there. Okay, the best month I've ever had with Mech I did $56,000. That was my best month ever. It was fantastic. I dropped out making 10K a month for 3 months. I dropped out in April of, in fact, it's very soon. I dropped out in April of 2025. I moved back in with my parents in May of 2025, moved out in July, got my apartment in August. I've been here since. I moved away from Mech in October, went full-time with Squid and Mech. After 10 to 20K months, I was roughly estimating 10 to 20K months up until about October. Then I had my biggest month in October, and then I had my biggest month in December, had my biggest month in January. It's just been one steady increase and increase and increase. But this is a very tedious process, right? Trading is not going to be straightforward. I'm going to have psychology videos, and they're going to be clearly labeled psychology videos because there's a difference between technical teaching and mental teaching, right? I have to separate those worlds. Right now, we're starting with theory. Right now, we're starting with basics. Then we're going to move our way on and cover each little bit whenever I feel like it's necessary. We're going to get through all the technicals first. Then after that's done, we're going to go psych on all the psychological things you could ever experience. I want this to be a one-stop shop for your trading. I don't want you to have to go anywhere else. I want this to be the last thing you ever have to do. Our next lesson will be on market structure and market states and all that good stuff. But that being said, let's move on. Let's get to theory, and then we'll wrap up today's video. I don't want to keep you guys long. I want to, make sure we're efficient with our time here. So let's talk about market efficiency and what models are trying to accomplish around strategies, right? You have to understand everybody is trying to do the exact same thing for the most part. You're either aware of the game or you're not, okay? How you do that determines your win rate and determines your risk reward and profit factor. I can assure you right now, my model is going to break a lot of the rules that you think are true. A lot of things that you've been taught by people that make drastically more money than me, whether or not it's from trading or not, I'm not 100% confident. But a lot of that stuff isn't necessarily true. Just because they make more money than me does not necessarily make their trading better. I know people that make less money than me that are better at trading than me. The thing is, money does not always equal performance in terms of market. Because if you have more money, you make more money. It's just the percentage at which you scale, right? I started with literally nothing, right? You have to understand, I come from a single mother household, fucking $150,000 of college debt paid off by the time I dropped out. Like, I was paying my way through college by myself, okay? I had a job, I worked 2 jobs, I've been fired. Like, I come from nothing. I bankrupted myself from trading. I bankrupted myself, well, not officially bankrupted, but I lost every single dollar I owned in the summer of 2023. As well as, again, I lost a very large amount of money, about 8,000 or 9,000, I think, something like that, my freshman year of college, because I was a fucking idiot. It was like very beginning of freshman year of college. I was a moron, okay? I come from nothing, so the rate at which I scale, the rate at which you scale, the rate at which everybody scales is going to be drastically different. Don't compare yourself to anybody. Trading is going to be a lonely game. Compare yourself to yourself yesterday and where you want to see yourself tomorrow. That's the only comparison you should ever make. That's it. Don't worry about the 6 month, don't worry about the year, don't worry about the 10-year. Focus on yesterday and focus on tomorrow and let today speak for itself. That being said, okay, every single strategy is trying to, at least should be, trying to find inefficiency and efficiency. The accuracy which you do so determines your profitability, how much money you can make, etc. The Mech model is going to essentially cover 90% of what we call implied moves. An implied move is a term that I use for all of the seemingly correct answers in the market. Any fucking person with a brain can look at a market and say when there's opportunity and when there's a lack of opportunity. And so if you look at the market now, you can see where do you see opportunity just in this little chart? Well, opportunity 1, opportunity 2. Where do you see lack of opportunity? Lack of opportunity, right? How are we making money in here? Okay, let's zoom out some more, right? Take a look at this price action here. What do we see? Opportunity, 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 right? It doesn't take a fucking genius to realize that there are opportunities and non-opportunities in the market. How do we take advantage of that? Well, that's how I built Mech. I reverse engineered as many of this shit as possible and then backtested this for years. Years and years and years of data. A lot of the shit you're just gonna have to trust me on until you backtest it yourself. You have to understand I built these concepts myself. I had to convince myself that these things were true. I would have to start with presuppositions with this shit and be like, okay, in order for all 10 of these rules to be true, this rule up here has to be true. And I banked on that shit. You have to understand, it had to be true. And I got really lucky and I just put so much fucking time into this shit that I happened to be right. And so this model works across any equity. Any model usually works across any equity for the most part. The reason why we trade these equities, being NQ and ES, is because they're the most liquid, they're hard to manipulate. What do I mean by manipulate? I mean, it would require, and there's like this general idea that institutions are trying to manipulate you out of positions or some shit. That is not real. I want to make that very, very clear. That's not a thing. Like on the higher time frame, sure, like there's large scale manipulation happening, right? But to say because your 1 minute fair value gap got inverted, the market makers, no, you're a fucking idiot. No, you're just bad at trading. It's not manipulation. Maybe the way you're thinking about trading is wrong. I followed all the shit that you guys watched, the TJRs, the PBs, the ICT. I followed all that shit. I watched all that shit just to realize that it's all built so that you build your own model. ICT concepts are built so you build your own model off of it. The shit that they teach is just, they create these set truths, and they're just not true a lot of the time. And I want to break those barriers and change the way you think about the market. It will be a completely fresh and unique perspective. I promise you, this model is completely new. Completely new. You've never heard of this shit before, I promise that. And the way we execute, you will never see some shit like this ever again. First and last, first to do it. Everyone's going to try and copy it after, but it is what it is. So there's opportunities and lack of opportunities, and this comes to efficiency and inefficiency. Overall, the market is trying to establish a range of efficiency. What do I mean by efficiency? I mean availability of buyers and sellers on both sides of the market. You have to think about the market as a balance, right? A scale. And there are buyers and there are sellers. And the whole point is to allow as many people as possible to agree at one point in price. Now, what makes it complicated is there's so many different higher time frame biases kicking in. You've got 15-minute bulls, you've got hourly bears, you've got 4-hourly bulls, you've got weekly bears. You have all these time frame people doing different things. But overall, it encompasses this big market that's consensus. Consensus on price. That's all that the market is, a consensus on price. When price isn't moving anywhere, it's because there's a consensus on price on that time frame, among other time frames, right? When there is large movement in price, it means there is a lack of buyers or a lack of sellers or an influx of buyers or an influx of sellers entering the market, meaning a lack of consensus. So the market's going to be drawn towards consensus. That's the way we want to think about it. The market's going to be drawn towards where there is, if consensus is not achieved, it's going to move to an area of the market where it can grab more people to achieve consensus. But overall, big picture, zoom out, we're trying to achieve market consensus, agreement on price, right? Buyers and sellers coming in together, shaking hands and meeting in the middle, right? That's the idea. A consolidation doesn't mean low volume. When people look at this, right, and they see market structure like this, for example, and they're taking a look at this, they're like, well, this is just lack of volume. Well, that's not necessarily the case, actually, right? If we're to just count just from this little section here and do something like this to show the volume of this consolidation, there's 234,000 units of volume in this consolidation, right? A lot of beginners would look at this and say there's a lack of volume. Let's compare that to the biggest move here, right? From the biggest move to the top, from the low to the high, the biggest move, there's 89,000 units of volume exchanged on the biggest part of this move. So why am I showing you this? Well, obviously the time at which we're spanning is going to impact it since there's more time for trading activity to take place, but the market isn't just about volume. Volume is incredibly important, right? We call this the total float. The total float essentially is the amount, holy fuck. Oh my God, the amount of people on one side of the market, okay? The total float of buyers, the total float of sellers. That is volume, right? How many people are there, right? And we have what's called rate of change, which is how quickly they move from one side to another, right? So think about it like this, right? If you've got equal groups of people moving between both sides equally, the market's not going to go anywhere, right? The reason why we moved up doesn't have to be because of an influx of buyers. It could just be a withdrawal of sellers at this high here, right? At this level here, a withdrawal of those orders, those short positions are taken away from the market. The lid is taken off from the market, and so price can go higher. There's no one there to stop and beat price back down again, right? It's all about total float. It's all about rate of change. How many people are there and how many people move from one side to the other? The biggest point in trading is to find a strategy that can effectively find where the total float will change and what the rate of change shift would look like to indicate that a total float change, a sufficient total float change has occurred so that a large market state transition can take place. What do I mean by this, right? Think about total float as an influx of people being added or taken or whatever from the market. Being, at the high or at the low, people are coming aggressively. Pause, like genuinely, holy pause. Fuck, this is gonna be a long fucking boot camp. Jesus Christ. Strap in, boys. Fucking strap in. Total float is the injection of orders, right? The injection of orders. And this is going to be the pinnacle of every big move. An injection or a withdrawal of orders, right? People being added, people being taken from the market, okay? Our goal is to find when a sufficient, what characteristics happen after a sufficient total float change that would sponsor a rate of change. So basically think about it like this, okay? If you're in a building and the building gets hit by a plane, and you don't, or if you're in a building and the building next to you gets hit by a plane, Jesus, where am I going with this one? Okay, if you're in a building and the building next to you gets hit by a fucking plane, right? And you're asked, fuck this analogy. What am I saying? Holy fuck, I need a fucking bag. What am I saying, bro? Genuinely, what am I fucking saying? Jesus Christ, it's not that complicated. All that we're trying to do, literally, all that we're trying to do is identify when a total float change happens, where volumes are exchanging hands, where there's an influx of people or withdrawal of people in the market that would sponsor a bunch of people to make, whether irrational or not, a liquidity-based decision that would change and control market structure to that new injection. So think about it like this, right? You've got some type of price well, that's a little bit far off. Some type of price activity, right? Let's say an injection of short positions come in, right? Oh, we fill a bunch of short positions, a bunch of short or long positions enter the market aggressively, right? What would sustain, what are these long positions hoping to do? Well, they're hoping to move the market higher, right? Obviously, that's the idea. They want to make money on their long position. So if this liquidity injection and people entering the market for the first time, this injection of orders into the market is aggressive enough, what conditions would happen after this injection, after this total float injection, to cause some type of rate of change shift to happen so that the new trend of the market's going to be bullish, right? That's the idea of total float and rate of change. What big event is big enough to cause other people in the market and outside of the market to agree with this liquidity exchange, right? They're able to side with that liquidity exchange and change the state of the market. So like, for example, here would be like your total float change, and then somewhere in here, the symptoms of your rate of change happen so that the trend now shifts to bearish, right? The idea is some big liquidity event happens, people taken in, or people put in, people taken out, which causes enough people to make new decisions about where the market's going to go, right? How big of a total float change will sponsor a rate of change shift? That is all that the Mech model is trying to accomplish, and it does it on a local time frame. So you can execute this model like over and over throughout sessions, no matter what. We can only control executing the position. We can't control where liquidity is. We can't control where agreeable price is. We're not going to worry about other time frames. We're going to sit and rest on what we call the resting time frame, which is the 5-minute time frame. That's where we sit on. I do not use an hourly. I do not use a 4-hourly. I do not use a daily bias. I don't use a weekly. I don't use a fucking daily. I don't use any of that shit. All we do is sit on the 5-minute. It's all you fucking need. It's a mechanical model you can execute and execute and execute. We will have ways of determining price efficiency before we start chopping. We'll know what to do in those chops, how to avoid that shit. It is flawless. The Mech model is built off of the symptoms of a rate of change that happen after a total float shift. That is, in summary, what the Mech model is doing. When we talk about market states in our next lesson in market structure, we're just going to go more in depth on like how to read this shit and what we're doing. Specifically, we're going to talk about how we're taking state changes to efficiency and inefficiency. But one thing I just really want to leave you guys with is, just because we move up doesn't mean that there are people like aggressively buying or whatever. It could just mean a withdrawal of sell orders, right? And just because we're consolidating doesn't mean price is slow. It just means that people are in agreement. It could be 10 people. It could be 10 trillion people, right? If you have 2 fat hoes on a fucking scale, 2 fat bitches, and 2 feathers on a scale, they're going to be at the same level, right? Right? But you take a fat bitch off, you put a feather on, boom, right? It's going to be fucking massive, right? Fat hoe goes up, or well, fat hoe goes down, feather goes up, right? That's how fucking gravity works or some shit, so I've been told, right? That's what could be going on here, right? Just because big candle go up, big candle go down does not mean buys and sells, does not mean enter position. The idea of entering on breaks in structure and fucking inversions is shit that we're not going to be doing. We're not going to be doing that shit. It doesn't mean massive buys or massive sells. Our goal is to understand when we are inefficient and where is efficiency, and is the RR between those two ranges enough for us to take a position, and if it is, how can we do risk management that is market-based, not risk, like personal risk-based, and if that personal risk is there, we take that trade. Where do we trim? Where is our efficiency at? where would our extensions be, what would our final take profits be, and then how do we take that inversion on a new total float shift with new rate of change conditions back up to the upside until eventually price consolidates again, right? Our goal is to ride 90% of the moves. Our goal is to be a part of all of this, right? We don't want to take one trade a day. We don't want to execute one trade a day. That's one thing you're gonna learn from me if you haven't already from my shit. I'm gonna take one trade a day. I'm gonna execute one trade a day with a fixed RR. I'm gonna target a 2-to-1 RR. I'm gonna wait for a London high sweep and a 1 minute fair value. You are fucked. You are fucked. I promise you're fucked. That is the most retarded way to think about the market. We are not doing that at all. Like I said, what we do here is going to be completely unique to me and to this. This is all new shit, okay? Not what we're doing. We're executing like a motherfucker, okay? If you were to backtest a TJR, an ICT type model, a PB type model, any of the models that these gurus, by the way, this shit that I'm teaching you is better than all those paid fucking like $3, $4, $5, $8,000 mentorships. It's just way worse. I'm doing this shit for free. Cause fuck them, bro. Cause fuck them, right? Cause fuck them. It's gonna be way better. Way fucking better. We want to execute like a motherfucker. If you backtest those trades on like 10,000 days of data, you're gonna find out those motherfuckers are shit ass models. Shit ass models, terrible. They might make a little bit of bread from time to time, but the more you execute, the more it's questioned, right? That's not the way our model works. The more you execute, the more we make. It doesn't mean every single trade is going to be a winner. Some trades are going to fall flat because what can't we control? Where liquidity is, where higher time frame agreement is, where efficiency is. We respond to efficiency with a lack of trading, but our goal is not to just stop at one trade. We want to execute. So the one last thing I want to leave you with is kind of an analogy with this model, okay, and how trading works, okay. You want to think about trading as a dog pile, right? It's a stampede of people trying to be right on some short-term, high time frame, some type of range in time to be right about price movement. That's what it is. That's all that this shit is. And basically, it's kind of like a fire, right? Everybody wants to know if a fire started. Well, how do you tell if a fire started? Smoke, right? If you got a fucking fire, right? How do you tell if that fire started? Well, you've got to have smoke. So let's say we have a cloud of smoke here, right? Boom, 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 boom. Okay? This is your cloud of smoke. And essentially what the Mech model is trying to do is say, well, what does smoke look like? Smoke would confirm a fire, would confirm the total float, right? So we want to study all of the conditions that happen in the smoke, right? So that we can confirm whether or not there's fire, right? If we know that for 999 fires, right, the smoke appeared in this particular way, what does it look like, right? We want to dogpile on that as quickly as possible before everyone else finds out that there's fire, right? The goal is that the fire is going to be your total float, where that change happened, and the smoke is going to be the rate of change. Because if everybody realizes that this total float change has already happened and that rate of change happens, they're going to fucking dogpile in. You're never going to get your entry. But if you're too early and that total float change is not substantial enough to move the market's not going anywhere, right? You're just too fucking early. That is what the Mech model is trying to accomplish. Identify the smoke to a fire we don't know exists yet. And then once we have identified the smoke, get in that trade before everybody else does. That is what the Mech model is trying to do. Now, we have one last thing I need to talk about, which is called value. It's a very simple idea. We have what's called fundamental value. We have what's called traded value. Fundamental value is the absolute worth of something. It's a really impossible thing to get in a stock market or in a futures market because primarily stocks are forward looking, right? So like they don't accurately display the worth of something. It's just agreement on price. Now some things are actually pretty well priced. The markets are incredibly well engineered and very advanced. A good example of this would be like oil. Oil is a really good example of this. A very well priced asset. But something like Bitcoin is almost entirely in principle built off supply and demand, not necessarily functionality or use. Its whole value is in the derived value that people give it through supply and demand, versus like an XRP or like a AVAX or like a whatever crypto that has some type of technological purpose. Maybe I'm just uninformed, but really all I'm trying to say is that there is a worth to something and then there's a traded worth to something, and often there's a massive divorce between those two, right? What something is actually worth versus what people agree on its worth, Like Tesla, for example, their sales are shitty, their cars are fucking ass, no one wants Teslas, they don't deliver on their promises. There's a million reasons to look into Tesla being a shit company, but it's a forward-looking company. It's an AI data company, not a car company. They underperform a lot of American car companies, and most American car companies from what I've seen, and especially underperform foreign electric car companies. So why is Tesla so overvalued, almost $400 and something $50, right? It's because it's forward-looking. Its fundamental value is not in principle based on sales. It's based off of future prospects. And so our goal is not to understand the fundamental value of these assets, right? We don't really care necessarily about how much the NASDAQ is worth today or how much it will be worth in the future. We don't really care about that. We're speculating on liquidity, right? We're viewing liquidity from an unbiased, non-investing standpoint, saying, where do people agree? Where do people not agree? How do we take transitions between those 2 points? That is all that we're doing. That's what's called traded value, right? How much people are willing to offer and sell something for. And the thing is, we'll have news events that we call macros that will change the fundamental value, right? You don't want to be executing trades that are based off of traded value, which is what our model is, when the fundamental value is changing. Think about it like this, right? If you found out that you were the owner of like some crazy rare car that in your head was only worth a couple $1,000s, but then you see a news article saying that they're looking for this one car, there's one out there, and it's your exact car, and it's actually worth fucking $10 million, right? You wouldn't be as fucking ready to sell that bitch for like $2,000 on Facebook Marketplace, right? You wouldn't, because the fundamental value has changed beneath your feet. A macro, or really macros or big news events, are essentially changing the fundamental value of the thing that you're trading. So we don't want to trade when that's happening, right? Because the thing is changing value, right? If you're executing a position on gold and then big news on gold hits, all of the technicals that went into the trade before that news delivered are completely irrelevant to that news, right? It's two different worlds. Pre-news world, post-news world. The market is consensus, right? The market gets it wrong all the fucking time, all the time. And it's really just trying to speculate on where people agree and speculate on particular news events. As you get closer to big news events, you will see price will try to move in volatile ways to reach consensus before news events. And if it's accurate, then the market shouldn't go up or down too aggressively. When the market moves up or down too aggressively off of news, doesn't necessarily indicate that the news is that intense. It could just mean that the market failed to capture the fundamental value before the news. Consensus was not reached, and therefore that big spike up, that big spike down was just a recorrection in the market. Everything is about recorrecting to fair value and fundamental value. It's like this big game of oscillating towards fair value and trying to effectively price something where people agree how much it's actually worth, like from an anatomical standpoint, and then like liquidity, right? It all comes together in this big blend. Now, like I said, not every news event is going to necessarily indicate like massive bullish, massive bearish. It could just be overcorrection before news or undercorrection before news or whatever the hell the case may be. Your goal is not to trade during news events. Don't fucking full port evals during news events. It's fucking stupid. That's so retarded. There's literally no point in doing that shit. 2-3 mech trades and you can pass a set of combines ready to be activated in XFAs. That's going to be something we're going to talk about later on. Actually applying this shit, how to pass accounts, how to get payouts. Like the goal of the series, teach you theory, teach you technicals, teach you entry, teach you sizing, teach you psychology, teach you farming prop firms, teaching you transitions to live account. You're going to watch me do it in real time. That's the whole point. I'm going to teach you fucking everything. And so, right, you don't want to fucking fool pour your evals and that shit. We have two types of news events. We have what are called paper deliveries, and then we have what are called testimonies. You can look at this on forexfactory.com. It's basically a website where you can monitor when these macros will occur. Paper deliveries, since the market is essentially consensus, it's a consensus machine. When a paper delivery hits, basically the market will immediately internalize it and understand where price will go as a result of that news. So think about it like a piece of paper that is given to the market, and that market immediately interprets it. It's all algorithmic, so it immediately interprets the data and understands how to correct to it, and orders will follow, and then liquidity will follow. We don't trade that. So if we have 10 a.m. paper news, we don't trade that. We have 2 p.m. paper news, we don't trade that. We have what are also called testimonies. Trump speaking, Powell speaking. Well, he's not technically Fed chair anymore, but right, when you have FOMC conferences, when you have these big testimonies like speeches or whatever, you do not trade them. one sentence and your accounts are gone, because the behavior of price around things that change fundamental value is completely separate than what we're doing, right? We trade traded value, liquidity based trading, not news, not fundamentals, right? Two distinct worlds. Anytime those worlds mash together, the Mech model does not work. The Mech model does not work. I had to find out the hard way, right? I'd be backtesting like, holy fuck, what the hell was that? I go on Forex Factory, some fucker said no more oil. Boom, right? Obviously a fucking pointer isn't gonna hold through that shit. You have to understand those two worlds, those clash. We don't want to trade that. Does that mean we're not going to trade on news days? No, that's fucking stupid. That is actually fucking retarded. It's so beyond stupid. You're trading combines and XFAs. Even if you're trading live accounts, it doesn't make any fucking sense not to trade those days. These are the best days to trade. A lot of fucking speculative volume, a lot of liquidity transfer happening on those days. It'd be fucking stupid not to. So trade those days. Fucking, I don't know why that's a narrative. Oh, it's a no news Monday, I'm not going to trade. Oh, it's FOMC on Wednesday, I'm not going to trade. Do you trade? Have you executed a position? Like dead ass. What the fuck are you doing? Right? So monitor those deliveries. Make sure you don't trade during those deliveries. Just avoid it. Okay? We just want to trade when there's clean price action Monday through Friday. As far as sessions go, we have a couple sessions you want to worry about. We have the New York, we have the London, we have the Asia. And there's also smaller sessions, like there's like the fucking like the Sydney session, there's like an Icelandic session. Basically a session or a profile is when large time zones are executing positions. So you want to be in the market when the most amount of people are in the market. The reason why? Liquidity, right? More people participating, more money, more liquidity transfer, more volume. That's the point. As a new trader, I wouldn't recommend trading Asia, because you'll sit a week in Asia to take one trade that you could have taken during New York. Once you're profitable, it's totally fine to trade Asia. I trade Asia as much as I physically can. I have a cutoff at 9 p.m. I try not to take any positions past 9 p.m. because I need to put my ass in bed, okay? Papa needs to be up to live stream. I can't fucking do it. I'm an old man. I can't be doing that shit. But the New York Open is at 9:30, right? That's the New York Macro, 9:30 New York Open. The CME, the Chicago Mercantile Exchange, the futures markets, the volume kicks up around 8:30. The pre-market window, I call 8:30, 9:30. That's when the pre-market window is. New York Open, 9:30. You're going to see most of the volume trail down and trickle down to 11:30. And then we have the lunch hour. Think about it. People are hungry. They want to go eat some food. They're trying to go get some Chipotle. Market's going to die down between 12 and like 1 o'clock. Not always, but it's going to slowly trickle up. Does that mean we stop trading? No, it just means you can chill. You can vibe. You can rip a line. You're chilling. You're fine. Then volume typically picks up between 2 and 4 at the end of the session of New York. Then we have what's called the settlement window, between 3:50 and 4:15. You do not trade into these times. The 3:50 window is something I talk about all the time. This is going to pull back into the idea of fundamental value. A lot of crazy volume transfer happens around 3:50 to 4:15 during the fundamental value settlement window, when contract positions expiries happen and brokerages make you close positions. You see a lot of crazy liquidity transfer that has nothing to do with the previous price action. So all of your trades with the Mech model should be finished and closed by 3:50. You exit at 3:50. Hear me when I say this. You exit at 3:50, you little fucker. Gone. No more trading. Understood? Good boy. No more trading. 3:50, 4:15, you're done. Asia opens at 6. Now, Asia's different, right? Asia's different time zones. You got fucking Shanghai. You got fucking Tokyo. You got Seoul. There's more of them, right? You got, you know what I'm saying? Different countries open their markets at different times, right? And so how Asia works is it's kind of like this. One city, one city, one city, one city, right? Volume kind of is stacked each hour. So you have the 6 p.m., you got a 7 p.m., you got an 8 p.m., and then it kind of trails down and trails down and trails down. And then volume picks back up at 3 a.m. for London. That's when most of the London traders, most of those EU little fuckers, the fucking UK men, then pick up their screens and say, oh, wait, bruv, fucking pointer, right? They hop on, they're ready to go. 3 a.m., that's when London kicks up. And then you have that bleed over between London and the pre-market between 3 and 8, okay? So that's a big window in price. So take your trades when you have to take your trades. I would say, and we're going to talk about this in psychology a little bit, but adjust your life so that you can prioritize trading, right? If you don't know if trading's for you, then don't do that yet. Get good at backtesting first. I'll have a whole episode on how to know if you're ready to move to a funded account, if you're ready to know if you're going to get payouts, pass accounts, etc. Also want to know how to know if you're ready to go full time and how to set up your life to go full time. But with that comes a lot of work, a lot of practice, a lot of dedication with this shit. I know this was a lot longer than I anticipated it, but I yapped. My bad. But again, I'm doing this shit for fucking free. If you have any questions, please leave them in the comments below. Join the Discord. It is complete for free. Watch me live trade. It's complete for free. Tune in next Friday and Saturday for our standard bi-weekly episodes. They're going to be much shorter than this. I'm going to try and get them between 15 minutes and 45 minutes on a daily basis, right? I'm going to do them until I've taught you everything I fucking know that I can teach you. Obviously, Squid is on NDA, so you're not learning shit, bitch. But still, okay? I'm going to teach you everything I can. There's going to be a long journey ahead of us. I hope you guys are ready. Strap the fuck in. This is going to be a generational fucking run, a generational boot camp that I hope goes down as the most life-changing shit for some of you. You know, this is at the start of some of your guys' trading careers, so welcome. Like I said, join the Discord, join my community. Welcome to the troop, motherfucker. Let's run this bitch up. I will see you guys next Friday for boot camp episode number 2. Deuces, take care. I will see you on stream. Bye-bye.